Let's take a look at the markets. I rarely review the stock market itself, such as the S&P 500 and Nasdaq indices, but today it's time to address what's happening. We will definitely discuss the volatility, which is starting to rise. I would like to draw your attention to the volatility smile, which is extremely skewed towards the downside, meaning towards put options. We will also touch on trading volumes, and I will share a market forecast that might surprise you. There's a lot of talk about a recession. Let's see and understand what's happening here. As we can see, after a drop that lasted just under a year and amounted to almost 30%, the market has since grown by a total of 62%, compensating for all the decline and exceeding the maximum value at the beginning of 2022. The market has grown by 20%, which means an average market growth of 12% over this time, considering all previous years. Recently, we have had two extreme growth stages from October to April. The market grew by almost 30%, and now the ongoing growth is nearly 15%. At the moment, we are in a correction phase. The question is whether this is the beginning of a downward movement or just a correction. I want to say right away that, in my opinion, there is a possibility that this is just a correction. We might fall even further, and then the market might start growing again. However, I do believe in a crisis. I believe in the beginning of a recession by the end of the year. And I also believe that the market will fall much lower than its maximums. Let's look at volatility and what the market is telling us at the moment. As we can see, there are many strike prices and expiration dates presented here. And for all of them, volatility is starting to increase, with some reaching up to 16%. But I also want to remind you that the volatility of the S&P 500 is the VIX. So when you hear about the VIX, this is it. This is the volatility that I always show. Almost every company has its own VIX. Now, let's look at the volatility smile and what's happening there. The volatility smile includes different expiration dates and different option prices, meaning different volatility prices. As we can see, the volatility smile is sharply skewed towards the downside, meaning towards a drop in stocks and the stock market. Currently, the VIX is 16%, but for example, the VIX at $400 is 30%. You understand what I mean? That's exactly how this volatility smile is constructed. Of course, there's nothing particularly positive to note here. Investors and traders are hedging their risks quite seriously, meaning they are hedging the market by buying options. This is why options are undoubtedly more expensive for longer expiration dates. Let's then look at historical and implied volatility. As we can see, historical volatility is represented by the gray line, while implied volatility is the white line. Recently, the VIX has been significantly suppressed, ranging from $11 to $13, which has been the case for almost a year. This is why historical volatility has decreased so much. Using options, since implied volatility always returns to its historical values, trading volatility is usually easier. But I want to point out that the current situation is not quite like that. I expect that volatility will generally increase gradually as problems accumulate. Consequently, historical volatility will also gradually increase to around 13 to 15%. In my opinion, more significant declines might start after some time. Now let's look at the levels of options trading, as well as support and resistance levels. We can see that there's a huge volume concentrated at the $550 level. However, if we examine today, July 24th, we see that today's volume is mainly represented in green. As you might know, we have enormous trading volumes for zero-day expiration options, and this is confirmed by the data. More than half of the options volume falls on today. If we exclude today's data, we see that the situation changes slightly. The main volume isn't as large, but it is still concentrated around the $550 level. Let's immediately look at this level. We see that it was breached in pre-market trading today. I always say that if a volume level is breached in pre-market trading, it is likely definitively breached. Why do I mention this again? Because options are not traded in the pre-market and post-market sessions. Therefore, it's easier for market makers and investors to move the price and then consolidate it there. However, trading volumes change very frequently, and the market moves very quickly. As we can see, the main volume for put options is concentrated around the $545 level. This is the key level that we have not been able to overcome. Some might wonder why we stopped exactly here, and I am showing you that it's precisely due to this volume concentration. Now let's look at the market forecast. First, we'll examine September. Here we have all the concentrated information that the market currently possesses. There's a lot of information, and naturally the market makes approximate estimates. As we can see, by the end of September, the market forecasts that the S&P 500 index will be around $560. Surprisingly, this indicates further growth. The market is currently projecting this scenario, and I find it plausible. However, if we look at the end of the year, The market is forecasting the S&P 500 to rise to around $565 to $570. Again, the market is still projecting growth for the S&P 500. I also believe that we might see further growth this year. But sooner or later, due to high interest rates, a recession will begin, leading to a more significant market decline. I also want to mention that the current decline is partly due to Tesla stock, which is currently down 12% after disappointing earnings, and Google stock, which is also falling and dragging down the tech-heavy Nasdaq index. Now let's assess the Nasdaq index. As we can see, the Nasdaq has grown even more robustly, partly due to developments in artificial intelligence. It has experienced 3 growth phases following the initial decline. This growth was 50%, followed by another 30%, and the latest growth phase was 20%. So as we can see, the momentum is gradually slowing down. This is the current situation with the Nasdaq. Now, let's evaluate what's happening in the options and derivatives markets. As we can see, the Nasdaq is also rising, and naturally, the Nasdaq has its own VIX. We can see that volatility is increasing here as well. Looking at the volatility smile, we see a similar situation with a significant skew towards the downside, meaning towards put options. In reality, various indicators differ. The volatility smile shows one thing, while the market forecast shows another. At the moment, there is no clear consolidation. We will keep observing. Again, this is not financial advice. I am not urging you to take any action, just showing you what is currently happening in the market. The same trend is seen with historical and implied volatility. The gray line represents historical volatility, which has been suppressed for a long time and is now starting to rise slightly. As I mentioned, historical volatility is likely to increase gradually over time as overall volatility rises. Now let's look at the trading volume of options. Here we also see a significant volume concentrated at the $470 level for both call and put options. Currently, we have surpassed this volume, but we need to monitor today's trading as the market might close slightly above these levels. We need to keep observing. Additionally, there is a considerable volume at the $465 level. This is also a significant level that will not be easy to overcome. Additionally, we can look at the open interest. As we can see, the open interest for call options is at $500, and the open interest for put options is at $440. We haven't been able to surpass the $500 level, so we'll continue to monitor this. Now, let's look at the market forecast for the Nasdaq. As we can see, the market forecasts a price of $480 by the end of September, indicating a slight increase. By the end of the year, the market forecasts a price for the Nasdaq around $490, suggesting further growth. However, this is just hypothetical information. After the release of new data and reports, the information will change, and we will keep an eye on interest rates and asset balances as these significantly impact the market. Let's also look at the 3D volatility for the S&P 500. As we can see, all information about volatility and options is concentrated here. The same can be observed for the Nasdaq 3D volatility, where all information about volatility and options is also concentrated. Regardless of the market's direction, I adhere to the theory of smart position management. That means building strategies and portfolios in such a way that no matter where the market goes, we continue to profit. This is my strategy and how I manage positions. Make sure to check out my latest video where I discuss how I manage positions. Trading is currently very active. I sell options, hedge risk through buying options. Overall, when volatility increases, it is the best time for a trader. Traders profit from increased volatility. I especially love selling volatility. If you have any questions, feel free to write, and I'll try to answer them. Good luck to everyone.